Hi there, and welcome back to Chapter 2. This is the second of two videos for Chapter 2, and in this video, we'll look at Learning Objective 2, which is to use ratios to evaluate a company's balance sheet. Now, this is going to be a light introduction to the use of ratios. We'll get into ratios in more detail around Chapter 10, but this is as good a place as any to start. Ratio analysis is actually very important in interpreting and understanding the story that the financial statements are trying to tell. So what ratio analysis does is express the relationship among different items of financial statement data. And a ratio expresses the mathematical relationship between one quantity and another. So for example, current assets minus current liabilities is working capital, whereas current assets divided by current liabilities is the current ratio. And the thing to note is that a ratio by itself is actually not meaningful at all. It's just a number. So what we have to do is obtain ratios for previous periods and even from different companies so that we can actually make meaningful comparisons to come up with a reasonable interpretation for the result. There are generally 3 or 4 major categories of ratios. So the first is profitability ratios, which measure the income or operating success of a company for a given period of time, and that's where we look primarily at the income statement. Liquidity ratios look at the short-term ability of a company to pay its maturing obligations and to meet its unexpected cash needs. Liquidity ratios are strictly focused on the balance sheet. Solvency ratios measure the ability of the company to survive over a longer period of time. So we're going to be looking at debt to assets, for example. Going back to liquidity, that's the ability to pay your obligations that come due within the next year of the operating cycle. And the operating cycle, for our purposes, is generally 1 year. Working capital is the difference between the amount of current assets and current liabilities. Working capital is the components of the balance sheet that actually contribute to us being able to do our day-to-day operating work. Solvency, again, is the ability to pay interest as it comes due and repay the balance of debt at maturity. And solvency ratios, again, look at the ability of companies to survive over that longer period of time. So the best way to illustrate these is with a demonstration. So what I've done here is I've taken a snapshot of exercise 210 American Eagle Outfitters, and here's the information we have that's taken from their financial statements from 2022 and 2021. We've got current assets, current liabilities, total liabilities, and net income. Now also notice here that this data is scaled in thousands. So when we say current assets of 925,359, we actually mean 925,359,000. I'm going to use the numbers unscaled so that there's no confusion. But remember, at the end, the numbers are actually 1,000 times larger. And our instructions are to do the following things. The first is to calculate the current ratio for each year, but then I've added an addition here to also calculate the working capital for each year. Then we'll calculate the debt to assets ratio, and then we'll have a short conversation on American Eagle solvency in 2022 versus 2021. So if we look at the current ratio, the calculation is very simple. It's current assets divided by current liabilities. We know that the current assets for 2022 are 925,359, and the current liabilities are 401,763. So dividing the assets over the liabilities gives us a ratio of 2.3 to 1. So that means that for every $1 of current liabilities, American Eagle has $2.30 worth of current assets. That's a very healthy current ratio. Anything over 1 is usually pretty good. For 2021, the current ratio is calculated as 1,020,834 in current assets divided by 376,178 in current liabilities, giving a 2.7 to 1 ratio. Again, still very good. And when comparing one year to the other now, we see that despite very high current ratios, the current ratio actually went down from 2021 to 2022. So it was from 2.71 down to 2.3. The company's still performing strong, but not as strong as the previous year. If we look at the working capital, that little part that I added, we just take the difference between the current assets and liabilities. So for 2022, the difference is 523,596, and in 2021, the difference was 644,656. So as you can see, 2021 also had higher working capital, and that went down in 2022. So the company still has a significant amount of cash to be able to fund its operations, but not as much as the previous year. And usually we'll see a correlation. If the working capital goes down from one year to the other, so will the current ratio. Next, we'll look at debt to asset ratio, which is the solvency ratio. Here we're going to take total liabilities divided by total assets. So the total liabilities are $554,645 and divide that by 1,963,676 is 28.2% debt to total assets. So that means if we were to draw a pie chart for the total assets, 28.2% of those assets are related to debt. And that means that the rest must be equity, because in the accounting equation, assets minus liabilities is equity. For 2021, we'll take 527,216 divided by 1,867,680, giving us 28.2%. So the ratio essentially is the same from one year to the next, given the change in numbers. In relation to the total assets of the company, the amount of debt relative to those assets is less than 30%. And we could say that that's pretty good. But we would also want to compare that to other companies in the industry. And finally, just some interpretation. Using the debt to asset ratio as a measure of solvency shows that the company has remained solvent from 2021 to 2022. That basically its debts do not exceed the amount of assets available. So that brings us to the end of a brief introduction into ratio analysis. We'll do more in Chapter 10. Now you're encouraged to go ahead and work on some recommended problems. And if you have any questions, please feel free to ask.